Several reports suggest that concerns over availability of physical gold have now emerged in the global market. This is led by COMEX players who wish to take the possession of the yellow metal. Speculation over potential tariffs by US President Donald Trump has also led to the surge in gold prices globally. Several global players and refiners have now started imposing temporary surcharge or levy on gold deliveries. To discuss what led to this and now going forward, what could the implications be, we now have Mr. Prathamesh Mallya, Deputy Vice President, Research, Commodities and Currencies at Angel One, now joining us. Mr. Mallya, thank you so much for taking your time out and joining us here on ET Now. And first up, reports suggest that perhaps refiners have now started levying surcharge on physical delivery of gold on account of some factors that are playing out in the global market. You help us understand what is leading to this and what could the implications be on gold prices on account of this. We'll try and connect with Mr. Mallya in just a bit, but just to give you a brief sense of how gold prices have shaped up, remember we had a stolid 2024 and gold prices surged nearly 28% in calendar year 2024, after which gold prices have risen another 10% in this calendar year. Several factors which are aiding the move in the global market. But Mr. Mallya is back with us. Sir, if you can hear me now, I was talking about the reasons which led to the several factors that are shaping up in the global market, especially when it comes to physical delivery, and that refiners are now levying additional charge on that. What is leading to that and what could the implications be on gold prices of this?
I think the real situation is because of the uncertainty and the tariffs that is being imposed by US President Donald Trump, the gold price in the US has risen and it is creating a risk premium specifically in US. But gold prices have remained temporarily stable in the European markets or for that matter in UK. This has resulted into a difference of almost 20 to $30. So what really investors are doing is they're moving out gold from Bank of England and then they're taking it to the US market, specifically in commerce. So which has resulted into possibility of imposition of certain charges because the deliveries that are there on the Bank of England and the standard bullion mark in the COMEX is different from what is there on Bank of England. So this gold, which needs to be moved from Bank of England, has to be made in specific shape as per the COMEX requirements, which has resulted into these charges. Otherwise, if you're really talking about whether there is a physical deficit of gold, it is not there. It is just gold moving from one country to another country, which has created an unexpected gold rush, an unexpected gold consumption from one central bank to other central bank.
Understood. So gold is moving from England to US, but if you can tell us what is the price differential because of which this is happening?
That's it. The difference is $20 to $30. So if you talk in percentage terms, it is 1%, and if you analyze it, it is close to 12% to 13%. So yes, there's an arbitrage opportunity, and hence because of this arbitrage opportunity, gold is being moved from Bank of England to the US.
Because of this arbitrage opportunity, do you expect this to streamline and come at par over the next, say, 1 or 2 months?
I think it is purely on the basis of uncertainty that has been happening, basis the tariffs. Once the situation of tariffs normalize, I think all the situation will come back to normal because it really wouldn't be a matter of time wherein all the two markets will come at par. So it is just the tariff situation which has resulted into this opportunity, and investors are exploiting this opportunity.
Understood. So it's just a matter of time before both the markets come at par on account of arbitrage opportunity that's playing out in the global market. But if you can tell us the math for the understanding of our viewers, for 1 ounce of physical gold, how much paper gold and silver is traded in the global market?
I think if the difference is $30 and if 1 ounce, if it's converting it into India, is close to around 30 grams. So specifically, if you're talking about India markets. So in that sense, the difference is clearly 1% laying out over a period of 12 months. It turns out to be an opportunity of 12 to 13%. So equivalently, if you want to create an opportunity, I will sell gold that is there in England and I will buy what is there in US.
So my question was with respect to paper gold. So for example, if you have 1 gram or 1 ounce of physical gold, how much paper gold is traded? That was my question.
Paper gold, I really need to work that situation out, but then I really don't have an answer at this point in time.
Understood. We get that point. And when the situation is, when it comes to India, RBI has also been buying gold in order to stock up its reserves, right? After a brief gap of December, in the month of December, we started buying yet again in January. Do you expect the trend to continue going forward? Do you expect Reserve Bank of India will continue buying over the next few months?
I think the global situation, uncertainty, tariffs has resulted into central bank buying across the globe. So if you're specifically talking about RBI, I think they will continue to accumulate gold, and it has happened over a period of time. Now the current gold in RBI's treasury is close to around 800 tons. A couple of months back, it was 500 tons. We have moved certain amount of gold from Bank of England, and we also bought it to India. So yes, central banks would continue to accumulate, and it will clearly depend on the uncertainty factors playing out in the global market.
Several factors clearly playing out in the global market, but gold, meantime, it is although recovered slightly from the highest point that we saw over the last few months. What will your investment strategy be when it comes to gold? Do you expect the trend to inch higher going forward as well?
I think it is a given fact that inflation expectations are rising, uncertainty is rising. There is only one confidence in one asset, and that is gold. And it will not happen that gold will continue to give you returns every particular year. But if it is a situation of uncertainty and interest rates possibly on halt or say lower, and we can see gold prices moving further higher. But then $3,000 is possibly a psychological barrier. I think we need to have fresh set of factors for gold to move beyond 3,000 marks, say 3,500 or so. We really need a very uncertain, unknowable situation for it to move further higher.
And if you had to choose between gold and silver, given the industrial applications that silver has, and also because it has underperformed as compared to gold, where will your choice lie?
I think taking into consideration the uncertainty, I would put my money in gold.
Okay, so gold will be the preferred choice. Mr. Malia, thank you so much for taking your time out and joining us here on ET Now and helping us decode what the implications could be in the global gold market.